Faith, are you learning anything by doing taxes for other people?
Oh, yes, I think that's the most helpful thing.
Yeah. Can't help but learn. You learn by doing. That's your best real world lab. How about you, Alexander? Have you learned a couple things? Now, I don't know why you have to go through those two lists of questions. One's just all about Hispanics. And the other one you get down and he had me to add that question yesterday. And I just put all your names in there with a column that Sarah had to put in blocks so they drop down and you just click whoever reviewed it. So that's the procedure. It's a good service for those little old people. Some of them have very little income. Some of them have pretty good income. Uh, but now Sarah, last year she let a daughter, which looked like she's in her 20s, living with her mother, claim 2 or 3 foster kids. You get paid for keeping foster kids, and it'd be hard to prove over half their support. And the daughter got back over her taxes last year. That's an illegal return that Sarah did. But we know you can claim a relative. We know a sister or a brother does not have to live in your household. Adopted child is the same as a child. But a foster child, I haven't come across that. But just my analysis of it, nobody should have claimed those foster kids. Now, if I have a foster kid in my home, I keep it all year. That qualifies if I support over half. If I'm getting $500 a month for that child, I better prove that I spent $501 of my own money, which that lady was not making enough money to pay $100, let alone $501. I don't know how much you get for a foster child. Do you all? Pretty good though. Uh, but my brother used to keep a foster child, and I did his taxes. I never did claim them, but they got paid for keeping them. Then they'd get attached to them, and they'd be taken away and break their hearts. So that happens. Okay, we were on chapter on credits. We reviewed real quick the other day a chapter on inventory. Uh, most of you have an e-book for taxes, don't you? E-books. Uh, anyway, I went through the PowerPoint the other day on chapter 11. That was on accounting periods and methods. And I'm going to flip a little bit in the chapter. And so you don't have a book, that's okay. See if I can get my Elmo working. But for just 5 of you, I do appreciate you showing up on time and being there. The only one that was late last night was Mr. Taylor. He said he'd be a little late every day, but I didn't think that late. He'll work it out, I guess. He does have a baby. First topic in this chapter was accounting periods, and I think I told you the other day on the PowerPoint on accounting period. Got fiscal year and a calendar year. Now IRS is recommending that a proprietorship and a partnership both be on a calendar year. It makes sense. If you got a partnership ended in, let's say, May the 31st, then you got to allocate that income for 2 years back to the partner. and that causes confusion. So even an S corporation treated the same as a partnership should use a calendar year. Now we had a short year. If you go into business in June, yeah, file taxes for that year. It's a short year. If you go in business December, the last week of December, do a long year, which is 53 weeks. So that's pretty much it on accounting periods. Now from accounting periods, we went to accounting methods. And all of you are pretty much familiar.
Your TV's on.
Not is it? Well, thanks, Jessica. You should have told me that last year. This one is on. We know the two methods are the biggies, cash and accrual. And the cash method started a long, long time ago when there was a lot of proprietorships. It's still okay for proprietorships. I used to do a bunch of truckers. I had a tax business for a couple of years in Buchanan County. I had a bunch of truckers. I put them on the cash method. Well, they'd go out and buy $15,000 worth of tires in December, pay cash, so I could take them off of the tax. But they may not use their tires until the next year. The accrual method, you've heard about that so long. That's what your accounting principles, intermediate, cost, advanced, they all teach the accrual method. Because there is so much accounts receivable and so much sales and accounts payable. Now, the hybrid method is a combination of the two methods called hybrid. And it's just where, if you got accounts receivable and accounts payable, you use that as accrual, but nothing else. Both methods you still have to do. Now, the cash method, you would not have to do adjusting interest. You don't have to worry about earned income, prepaid expenses, accruals, deferrals. You don't have to worry about any of that. However, you got to worry about depreciation under both methods. And if I say you don't have to make adjusting interest or depreciation on the cash basis, you still got to do depreciation, take it off on tax return. Now, the cash receipts and disbursements. When you read this, be careful about prepaid rent, unearned rent. You know, football tickets, sometimes you prepay for those. You prepay your tuition, don't you? All right? But anyway, be careful on those. IRS don't like for you to prepay rent 3 years in advance and take it all off in 1 year. They don't like that. Okay? Now, we had methods also. We had an installment method, a completed contract method, and a percent of completed contract. Then we went to inventories, and I showed you on determination of inventory costs. I have to minimize that a little bit so you can see it. determination of inventory cost. And inventories may be valued at either cost or lower cost or market. Those are the two common ones on the form Schedule C itself. Now, these methods are on every business tax form. Sub S, C corporation, proprietorship, and partnership. They'll check the box on any of those business forms. Cost, lower cost to market is common. Taxpayers who use LIFO may not use the lower cost to market. In the case of merchandise purchase, cost is the invoice price less discounts plus freight plus other charges. You know how to get the cost of inventory. Back in some principles books, especially if you study the periodic method, which we didn't do it much, you only had, you bought materials and you debit inventory, and we put it in cost of goods sold on a perpetual basis. But on a periodic basis, you had to take beginning inventory, like you did on the test. Beginning inventory, which you did. Beginning inventory plus purchase minus inventory gives you materials available for use. But now, under periodic accounting, you would have taken beginning inventory plus purchases minus discount at 210 net 30 plus any freight in minus ending inventory to get your cost of materials or even cost of merchandise inventory sold. Salaries of purchasing agents, warehouse costs, package administration costs related to the function must be allocated between cost of goods sold and inventory. Unlike financial accounting, salaries of purchasing agents, keeping the warehouse, packaging, related to function must be allocated to cost of goods sold and inventory. So you're putting other costs in here. Now, some other inventory costs under unit car, the following overhead items are included in inventory. Now, here's some items that are included in inventory and probably manufactured. Factory repair and maintenance. That's all what in cost accounting. What is that line right there? That line is factory overhead. Factory supervisors, foremen, and taxes other than income. That's factory overhead. We know it's included in inventory. We just did it this morning. Other factory overhead items, actually rework, scrap and spoilage is put in factory overhead. We haven't got to spoilage yet. We haven't got to rework yet. And cost, current and past service, the cost of pensions and profit sharing, that's factory overhead. Service support such as purchase, payroll, warehousing cost has to go in somewhere. But we know that advertising, selling, or administrative and selling, okay? So they are reviewing some cost accounting concepts when you read this chapter. It's available to all taxpayers other than those who use LIFO. Market is replacement cost. We know that. Now, you've had inventory and intermediate. You can get into some complications even on inventory. When you're doing taxes, what is your inventory? All right. If you've got inventory in transit, Is that your inventory to count as your ending inventory? It depends, if it's FOB shipping point or FOB destination. If it's FOB shipping point, it is yours to count. If it's FOB destination, you don't have it, you don't count it. Okay? What else adds on to the cost of inventory? Of course, shipping does. If you have to pay taxes, it does. All right, now when I bought TurboTax, I bought it from Sam's, and I didn't pay any income, sales tax on that program because I'm using it for business purposes. I had a business Sam's card anyway, so all right. If I wanted to be dishonest, I'd go in there and get my personal stuff and say no taxes. But I always tell them, this is taxed, this is taxed. All right. Computer technology, including barcodes and software, are businesses to maintain real-time perpetual inventory records. Computers help you work smarter, not harder. We had to used to do a whole lot of perpetual, a whole lot of counting. Now you still should have a physical count of your inventory, right? You still should protect your inventory from shoplifting and all that. Okay? But there's another term here. Barcodes. Now, your books have barcodes, right? Not everything has a barcode. You go out to rent a car on it, don't have a rental car company on it now, it has a barcode, probably on the rental car. What's the name for that barcode? UPC. What does UPC mean? Universal Product Code. Okay. But back when that first came about, wasn't used widely. And stores, I guess, I don't know how they get that barcode to pick up their price. Like, your Cost Accounting book may have a barcode on it, charge you $90 used. Yours may have a barcode on it, charge you $250 unit, whatever. But I guess they got a machine that they put in the prices. You need to identify item at, say, Rose's and Walmart, and it'll ring up the different prices for your barcode. Barcodes also help some stores from shoplifting. If that barcode hadn't been scanned, the beeper will go off and you'll go out to go. Y'all know some stores that's had that. These special accounting methods, long-term contracts, has to be how many years? 2 or more. 2 or more. All right. Look at this example. Diamond Corporation, 2 types of airplanes, small general aviation planes that require approximately 6 months to complete. Large jets sold to airlines that require 2 years to complete. They maintain an inventory of the small planes, but manufactures the large planes to contract specifications, job order. Diamond can use long-term contract accounting for the large planes. All right? They offer aircraft design assistance to governments and others who seek the services. The long-term contract method of accounting is not available for services. Okay? Not for services, but for the airplanes, it takes 2 years to work. And usually you use a percentage of completion method on those long-term contracts. Completed method, I don't know if that's approved by IRS or not. That's all your costs, manufacturing costs. We won't go over that. Now, completed contract method, let's see if IRS approves it. Under completed method of accounting, contracts are reported in taxable year in which the contract is complete, without regard to whether the contract price is collected in advance or over time or installment. So when it's completed, you report the income and expenses. And we mentioned installment sales. Look at those steps again on installment sales. Compute the gross profit, selling price, adjusted basis minus selling expenses plus depreciation recapture, you get gross profit. Determine the contract price. Here is your formula. You divide your gross profit by your contract price. You get a gross profit percentage. In the year of the sale, and the rest of that is principal. Then you apply the gross profit percentage. I think you saw that on the installment contract form, and I think you see that here. When we decide to work a problem, that won't be too bad. I'm going to say one thing about deferred sales. Now, how about a store that sells furniture on installment method? You got 3 years to pay. Can they use the installment method? Yes. How about an automobile loan? That's installments. So there's a lot of installments that you're not thinking about. It's not just land, it's not just real estate or a house. Well, hey, now, here is USA Corporation, rural basis taxpayer. They sell land for 10, 100,000. They receive 50 down, that leaves 50 more. In 12 months plus 14% interest. The base of the land is 80,000. They sold it for 100, so they have a $20,000 or 20% gross profit. Because of the buyer's poor credit, the value of the note is only $45,000. They elect not to report installment sales on the installment method, but they'll report a capital gain of $20,000. If they collect the face of the note at maturity, no initial gain or loss is recognized. If they sell the note for $45,000, they can take a $5,000 loss. So you're not using the installment method on something of this nature. Okay? Deferred payment sales. We talked a little bit about inputted interest. Inputted interest. Now, when you see an automobile company advertising 0 interest, and they're doing it right now, today, aren't they? 72 months, no interest. Do you believe that? All right, if they got that vehicle price at $20,000, no interest. What could you get that car at if you paid cash and you didn't finance? Maybe $18,000. So it has $2,000 inputted interest, don't it? That's like if you buy a $1,000 bond from some corporation for $950. It's got $50 something inputted interest because it will pay you $1,000 on maturity. Changing the accounting method, I tell you not to do it. But look up the form if you need to. I want to say one thing about this. I'll show you this and how this works when we look at a corporation tax form. You've got gifts from a shareholder to the corporation and vice versa. You've got loans to and from. You'll better understand that if I show you that on a form. we looked at the installment sales contract, and that pretty much is the chapter, folks. Now we're gonna go straight to the end of this chapter. Um, Trying to find what I need. All right, number 37. I want all of you to look at that and jot down an answer. Now, number 37 on page 32. Now, have you got it up on yours, Lamont? Can you get page 37 of chapter?
I mean, page 32 of chapter 11.
Yeah. 11-32. Can you look at that problem? Okay, this is 2, 4, 6, 7, 9, 6, 7. Which has 1, 4.
It's 11-37.
Yeah.
Hey, Jesse, found another use for this. When you get 37 finished, I want you to jot down and do 41. Jessica, what do you think about A? Is it okay? The question would be, if the year selected is not appropriate, indicate what would be acceptable. So what did you say about A?
I said no. In January 31st.
That is problem 37. I don't know how they got this up there. Um, what'd you say to B part, say?
That's acceptable. It's
How
acceptable.
about C, Alexander? Acceptable or not? Is C acceptable? A corporation selects a year that ends on the last Friday in March. Lamont, how about D? All right, let's see what we've got. Jessica, you said not acceptable, right? So that'd be the 31st or 31st. That was your answer. All right. I don't know why they put this chart. All right. I believe C said acceptable on B. But Alexander, acceptable? Oh, no, it is acceptable.
How would that be acceptable?
You can pick the last Friday of any month for your corporation to end. You can. I
Or
did.
the last day.
Huh?
Or the last day of the month.
Oh, the last day.
Okay.
Okay, I was thinking it had to be an actual number today.
I did
Yeah.
too.
Well, the last Friday may end on the 27th, and the 31st ends next Tuesday. But that is acceptable. I don't recommend it. I like for it to end at the end of a month. The month was not acceptable based on the least aggregate deferral of income to the partners, and March 31st year end would be required. The calculation is as follows for D part, but that's because of the different partners. Now, looking at Lamont's there, a partnership selects a year that ends on December 31st and has 3 equal partners whose years end on March, April, and July. Now, those could not be individuals. These partners are probably corporations. So this partnership consists of 3 corporations ending their years on 3 different dates. So that's why D is so complicated. But March the 31st, whose does that match? That matches one of them, doesn't it? Don't know why they picked March 31st. They got calculations there, but don't get anything that complicated. And C, acceptable. E, an S corporation selects December 31st. That's what we recommend. Okay, now go down and look at number 41 real quick. You've had time to scan those a little bit. Are these cash-based expenses deductible for a cash-based taxpayer? Lamont, I'll start with you this time. Medical prescription costs $20 paid by a credit card. Is that okay? If we were itemizing, can we deduct it? Yeah. And Alexander, prepaid interest not related to points of $200 on a residential loan. That one gets a little more complicated.
I wanna say no works prepaid.
All right, look at your answers. Which two items are not deductible?
B and D.
All right. E is, A is, and C is. It don't matter if you borrow your money. Now, on D, have you ever watched any of these TV marathons and you promise to donate $100 to Club 007 or to Jerry Falwell's church or somebody's church? A promise to donate doesn't mean you paid, right? And then, let's say B, I told you to beware of prepaid items and deferred items and unearned items. All right, just trying to get a few of these things out of the way. I'm not worried about economic performance. All through accounting, a debt is a debt. And we assume if you bought supplies on accounts payable, you got the supplies and they're delivered, and that's economic performance. You have them in your storeroom, and we've always assumed that. All right, take a gander at 43 real quick. Just tell me which 1, 2, or 3 are not. 1, 2, or 3 are not. All right, Jessica, give me one not.
B.
Advertising. That's definitely not manufacturing costs. Safe, give me another one.
It's not.
Not.
Let's say, C, right?
Which one?
C.
Payroll taxes? That's factory overhead. Does anybody see another not?
D.
Which is what?
Research and development.
That's probably organizational costs.
How about on insurance?
What kind of insurance is it?
It says factory insurance.
That's it.
If it's factory insurance, it's overhead.
AC.
All right, it's got A, leave out B, E, leave out D, F, G, and H. So 2. A, not A, but
B and D.
B and D. Everything else is manufacturing costs. Okay. Should have got most of that from cost or managerial accounting. All right. Now we're going to take a minute and do number 45. We're going to get to problems in this chapter for sure. All right. This is a hard one in some areas, and it's easy in some areas, depending on how you look at it. Did anybody get the gain that should report? The whole thing was recaptured depreciation. That comes up in chapter 13. Recaptured depreciation is ordinary gain. So what does that do to the answer to this problem? 80,000 gain. Now I believe I told you before a little bit, section 1231 gain would be long-term gain. The section 1245 is recaptured depreciation. So the whole thing would be taxable. How do you compute a gross profit percent? That's hard because it's 100%. So what he reports, what was question B, Jessica?
How much gain is taxable in the year of the sale?
80. And how about C part?
What income does ACE report in each of the next 3 years?
Just the interest. And you report all the gain this year. Okay. We'll look at that 1231 and 1245 later. All right, not the best installment sales problem that I want you to look at. All right, let's see if we can do an easier one, more sensible, number 48. And I was looking at that. What's the name of that virus in China?
Corona.
Corona. And fellas, we're weaker because more men are getting it than women. Maybe we're the weaker sex. Right, Jesse? 15 cases in the United States, way over 1,000 died. And they're calling it the black swan virus. Okay, take a minute, calculate 48. All right, that one should be pretty easy for you. What gross profit percent did we get? What, 6/20? 6 over what? Remember, the sale is 100%, that's 20,000. Divide that into 14, what have you got, Jessica, 70%?
20,000 into 14.
70%?
Yeah.
That leaves 30% profit, don't it? Now, he takes 5,000 down the first year. What's 30% of 5,000?
1,500.
That should be your answer. If it's not, I'm wrong.
Yeah, because that's what I thought. I just didn't know that I did it right.
All right. 30% times 5 is 1,500. Now, what we did down here,
You sell the 3 remaining installments.
oh, you sell them for 13.8,
Yeah.
and your basis was 10.5, 70%. Wait a minute, you sell them for 15,000, right? Just multiply 15,000 times 70%, see what that gives us.
10.5.
See, that's the way I would do it. Okay? And my gain would be 3,300. That's easy enough. Okay, that's a little bit about the installment and to get you feeling a little bit better about it. On deferred payment sales, I'm not worried too much about. But I am going to go down and let you look at 56 for about 4 minutes, see what you come up with. You may have to use your accounting skills. While you're doing that, I'm going to run this down for the outdoor mail.
None.
That's hilarious. I forgot to get it to you.
Oh, okay, I'll take care of it.
About the one that you had with her kept me there for an hour.
No, we didn't forget about that or do it.
Okay, number 56. I don't know how much time you've put on it. Long-term contracts how much income from the contract must Keene report during the first year? All right. What was that number 50 what?
56.
I thought something looked funny. Did anybody come up with 360? All right, because it was 30% complete, right? 3 million over 10 million. Okay, now the gross profit would be 1,000,002. So we're going to report 30% of that. The reported income for the second year is 600,000 if you just follow. Was it 80% complete? 80% complete?
Yeah.
And we'd already counted 360. There's another way to do that. I'm not going to try to think of it right now, but there's another way. Reported loss for year 3 is, okay, this is easy. What is 30 from 80?
50.
What is 50% of 1,000,002?
6.
That's the way I would have done it. Okay. Now, C part. I guess you had more expenses than you thought. First off, you thought your expenses were going to be 10, right? But it ended up they were 10.5, correct? All right, so your income from the contract is 700 instead of 1.2. All right, you already reported $960 income, so now you can take a loss of 260. So that's refreshing your accounting's knowledge. D, Keene overestimated its income from the contract and as a result overpaid its tax. Under the look-back interest rule, Keene is entitled to receive interest on the additional tax it paid because it overpaid in the income in the prior 2 years. That happens a lot of time. Contractors take losses. When they give you a bid, and if it don't have an escalating clause in it, be aware of escalating clauses. It's just like escalating interest rates on a home mortgage. They can charge you 4 this year, next year they can raise it to 5. You want to go for a fixed interest rate. Now, they did not go for fixed expenses because you can't. So materials may have went up, labor may have went up, and whatever else may have went up. Okay, now that's a little wrap up of that chapter, folks. Now we're going to try to look at chapter 14, even problems. I've gave you a month of Sundays on that one. We're going to try to look at some of those on Tuesday. But we're also going to look at, some of chapter 12. Now, just going to say a few words about it today, then I'll let you go. Up until now, we sold property. We had one chapter where you had property that was flooded or fire, and how long you had to replace it. Well, last week down in my area, a place called Doran Bottom and Raven and the Mansion Mart in the Richlands got flooded. And some of the homes, I guess, got pretty nasty and burned. So